this video, we are going to just dive into the basic structure of how taxes are figured out, right? How do we go from we have income to actually calculating how much tax is owed? So I just want to give you a high level overview of the different steps involved. Now, how taxes work in the US, this is important to know, is that we are a progressive tax system. Okay, we use progressive tax brackets as opposed to a flat tax where it's like, hey, no matter how much income you owe 20%, or no matter how much income you earn, rather, then you pay 20% of all income. Okay, that would be a flat tax. We do have some flat taxes, just not income tax, right? There is, for example, a flat tax, like usually, this varies again, but like a sales tax, for example, is flat tax. Whatever your state has decided, it's a flat tax. Whatever you buy, it's that much. Okay, right? Some countries have a flat income tax, okay? In our country, federal level, we have a graduated or progressive tax brackets. So I'll pull up an example of that in a future video. But what that means is that certain portions or brackets of your income are taxed at different amounts, okay? So when we talk about tax brackets, they have income ranges, and only the income in that range is taxed at that percentage, okay? So again, I'll do a video walking through that and showing you how that works, but I just want to make that important. So there is a difference between your marginal tax rate and your effective tax rate. Marginal tax rate is the bracket that the last dollar of income that you've earned, it's the tax bracket that falls in. That is your marginal rate. So that could be 24%, it could be 32%, 22%, but your effective tax rate, you haven't paid 24 or 32% on all of your money, just on that last portion of your income. So to get your effective tax rate, you look at each bracket and how much tax you paid in each bracket, total up the amount of tax paid divided by total income, and that's your effective rate. So that's often lower than your marginal tax bracket, okay? So that's just something important. We'll talk about that more in detail. Now, the basic income tax formula on the 1040, right? The form 1040 is this, and I'm gonna run through this really quickly, okay? So we have gross income. That's total income derived from any source. It could be W-2 wages. This could be rental income, it could be investment income, interest, dividend, 1099. If you're doing freelancing or consulting, it could be 1099. It could be income from a business, right? It could be from an LLC or a partnership, right? That comes and flows through to your personal return. So all income, okay? So we take that as the total income. Then what we do is we take out certain deductions from that, okay? To arrive at your adjusted gross income or your AGI. So some of these deductions would be gifts, right? Gifts are not taxable to you. If somebody gives you a gift of money, like a monetary gift, it's not taxable to you. Okay? They could give you $100,000 or $1 million. It is not taxable. Okay. And the same for life insurance proceeds as discussed in the insurance module, right? If you have a big lump sum payout from a life insurance death benefit, that is not taxable. Okay. Gifts or life insurance proceeds. All right. Return of capital. So if you invested $10,000 into an investment and then you end up getting that $10,000 back, that $10,000 is not taxable. Though it kind of shows as income, it's deducted out because it's your original principal. It's your original capital you put in. Okay. Any gains on that, of course, would be considered income, but the return of capital is not. Okay, this would be business expenses. So if you are self-employed and you have a business and you have legitimate, reasonable, and necessary business expenses, that would come out of here. Capital losses would come out of here. So if you have an investment but you actually lose money, then that's deducted out against your income. Okay, it's a capital loss. Just like we have long and short-term capital gains, we have long and short-term capital losses, and those deduct against your income. 401k contributions, IRA, HSA contributions, all these contributions that are pre-tax, okay, not Roth, but pre-tax contributions, right, seek to lower the amount of income you're taxed on that year. So pre-tax 401k contributions, traditional IRA, pre-tax IRA contributions, HSA contributions, those all count. Those are all kind of deducted out. Now, the order of this, sometimes it comes out before gross income. The way they calculate is actually a little different, but I'm just giving you a good idea, okay? Student loan interest. So if you're paying on student loans, you can total the amount of interest that comes out here, and deductible portion of your self-employment tax. So if you are self-employed, you're paying self-employment tax of 15.3%. Half of that, which is technically employer paid, can be, once you pay that can be deducted out of your personal income. Okay. All right. So there are more than that. Obviously, those are some of the main ones that you really need to think about or worry about. Okay. After all those deductions, you get the adjusted gross income, AGI. You've all heard of that term. What is your AGI? Adjusted gross income. This is the income that then we really start at. Okay. So adjusted gross income. So you have your gross income adjusted for deductions. deductions, adjusted gross income. Okay. Once you have your adjusted gross income, then you take the standard or itemized deductions. Okay. The standard deduction is something allowed to every person, depending on your tax filing status. You have a specific amount that you can take as a deduction. Okay. So again, we'll dive into details there in just a minute when we look at tax brackets. But you essentially take your AGI and then you subtract out your standard or itemized deductions, and then you get to your taxable income. Okay. So that is the amount that your that is compared against the tax brackets and that your taxes are actually calculated on. So basically you calculate that based on your taxable income. So AGI minus standard or itemized deductions, get your taxable income, compare that against the tax brackets, figure out what your total tax bill is. Okay. So you calculate the total bill owed. Then there are some additional credits that come in, okay? And some of these are refundable credits, some of these are non-refundable. The basic difference is this. If you owe, for example, $6,000 in taxes, okay, and you have tax credit $10,000, if it's a refundable tax credit, it means that it will go dollar for dollar, reduce your tax owed. So it essentially offset your tax dollar for dollar. So if you owe $6,000 and you have a $10,000 refundable tax credit, then it offsets for every dollar of tax owed and every dollar of deduction of credit. It offsets 100%. So it offset all $6,000 of your tax owed, plus there's an extra $4,000 that would be then refunded to you and you actually get it. The IRS will send it to you in a check, right? Or deposit into your account. That is a refundable credit. A non-refundable credit only credits up to the amount of tax owed. So if you have a $6,000 in tax owed and $10,000 non-refundable tax credit, it will reduce your taxes dollar for dollar up until the break even. So $6,000. The rest of that $4,000 basically just goes away. It's non-refundable. They're not going to send you a check for that amount. Okay, so there are a number of different refundable tax credits, some that are non-refundable. We'll talk about that in a little bit more detail. But after all of that is said and done, you have your total taxes owed. Okay, now if you are a W-2 employee, right, you have taxes withheld out of your paycheck. Where do those factor in? Those factor in to your total tax bill that you have to pay. So once you figure out your total income tax owed, they look at your W-2s and all the money you had withheld for federal tax, and they, offset your total tax owed. So if you had $10,000 withheld for federal taxes over the course of a year, and it calculates your total tax owed as $6,000, then all it means is that you withheld a little bit more than you actually owed, and you would get a tax refund. That's where the tax refunds come in, okay? So tax withholding, they're not charging you tax. It's just like you're paying your tax bill in advance. Then in April, when you file, they will look at your total tax owed based on all these numbers, and then look at how much you've already had withheld through the year for that tax bill. And if it's more, that's where your refund comes in. So some people are super excited to get a huge refund. All it means is that you withheld more than you needed to throughout the year. You withheld more for tax than your actual tax bill. And so they're sending you that money back. Okay, that's all it means. That's how tax withholding works. Sometimes you look at your paycheck, like especially if you earn commissions or a bonus, and you look and you're like, whoa, I got taxed 40% on this money. Well, no, you didn't get taxed 40%. You're taxed at your normal rates, but maybe 40% was withheld to pay the taxes. Okay, so it's not that you pay more tax on a bonus or commission. It's all just normal income. Okay, but it was withheld more. They withheld more and sent it to the IRS. So when you file taxes, all of your income counts for the same, and they might say, oh, hey, we actually withheld too much. Here's money back. Here's a refund. Okay, so that's the general formula. We'll talk about specifics on these things coming up. But gross income, right? Total income coming in, less deductions of all those different types, and there's some others. You get your AGI, adjusted gross income, less your standard or itemized deductions, and you get your taxable income. Okay, and then you calculate your actual tax bill. Then you look at your allowable credits, and those offset your taxes dollar for dollar, sometimes refunding you, sometimes just only offsetting up to the amount of tax owed. They factor in how much tax has been withheld already, and that is your total taxes owed. Okay, pretty straightforward. There's more than the 1040. Obviously, there's a lot of different forms and worksheets that all feed into the 1040 depending on your situation, but that is the general formula of how it works. All right, okay, that wraps up this video. Let's move on to the next.
Subscribe for more financial tips